Hello, in this presentation we will be discussing two interesting currency pairs, the Australian-American pair and the American-Japanese pair. This analysis will be based with a short-term perspective using economic indicators such as relative interest and inflation rates to gauge the future performance of these currency pairs. To begin, we will address the Australian-American currency pair. For reference, according to the website of the Reserve Bank of Australia, as of the 16th of April 2018, the Australian-American pair equaled approximately 77 US cents. Firstly, to analyse, we will look at their relative interest rates. This graph is the Australian interest rate over a 3-year period. In this graph, it is evident that since December 2014, there has been a decline in interest rate. With the interest rate currently at 1.5%, this is the lowest it has ever been. Looking at the graph, the rate has not moved from here since 2016. Therefore, it is likely that the interest rate will remain the same in 3 to 6 months. However, the decreasing trend of the graph suggests that there is a greater chance that the interest rate could decrease in the future. The way that interest rates affect the exchange rate goes by the notion that the higher the interest rate, the more capital inflow there will be. In contrast, there will be less capital outflow, therefore increasing the currency's value. However, Australia has a relatively low interest rate compared to America. According to an article from The Guardian, the American Federal Reserve raises interest rates again amid strong jobs market. In late March 2018, America's interest rate increased by 0.25%. Since America's interest rate have increased, therefore their currency value is also expected to increase in the near future. Such events will lead to a decrease in the Australian-American exchange rate, as $1 Australian dollar will be exchanged for less American currency because the American dollar will be worth more. Therefore, it is expected that the Australian dollar will depreciate with respect to the American dollar. Next, we will look at relative inflation rate. This table shows that the average consumer price index showing an overall increase since 2014. This long-term increase from 2014 levels is more significant. The fact that the consumer prices are increasing means that inflation is increasing. Therefore, there is a likelihood that inflation could continue to rise in the coming months. Higher inflation means the demand of goods from Australia to other countries will decrease because the cost of goods and services have increased. It also means the supply of goods and services from other countries is less expensive. If the inflation continues to increase, countries could seek to import goods elsewhere, therefore lowering the value of the Australian dollar with respect to the American dollar. In conclusion, based on the predicted decreasing interest rate and increasing inflation rate, it is expected that the Australian dollar will depreciate with respect to the American dollar. From this, we predict in the near future that the exchange rate will decrease from current levels. Now, we will discuss the American-Japanese currency pair. For reference, the current American-Japanese exchange rate as of the 18th of April 2018 is approximately 107 yen. Firstly, looking at the current political climate. According to Forbes and CNN, President Trump is looking likely to further increase trade tariffs on China, who the US has a trade deficit of hundreds of billions of dollars. These tariffs increase the price of goods exported from China in a bid to make American industry more competitive. However, China has retaliated with their own tariffs on US goods. As the two nations continue to increase tariffs, prices of goods are likely to continue to rise over the next few months. This would encourage more imports into the United States to come from other countries where prices are lower. As China and Japan are both massive exporters of electronics, it is entirely possible that the US may now import more goods from Japan as Chinese imports become too expensive. If the demand for Japanese goods in the US increases, then Americans will be trading their dollars for Japanese yen to purchase said goods. This would increase demand for the yen and supply of the dollar into the foreign exchange market. driving the price of the yen up and the dollar down. Assuming all factors remain constant, these tariffs would make the US dollar depreciate against the Japanese yen. Next, we will look at relative inflation rates. So far in 2018, the dollar has depreciated against the Japanese yen. This makes sense as inflation rates in the US have been significantly higher than that of Japan's. This can be seen in the most recent consumer price indexes released by the Ministry of International Affairs and Communications. The Japanese inflation rate has been rising rapidly over the past half year, increasing by 114% from September 2017 to February 2018, while the US inflation rate has only increased by 20% over the similar 6-month period. If inflation in Japan continues to rise at the rate it has maintained over the past few months, it is likely that it may catch up with the rate in the US. A high rate of inflation is known to reduce demand for a country's exports and increase their level of imports. If that were to happen to Japan, the demand for the yen would fall while the supply would rise. This would ultimately make the dollar appreciate against the yen. Furthermore, looking at relative interest rates, according to the Bank of Japan, Japanese interest rates have been on target at -0.1% since 2016 and are not expected to change within the next 6 months. The US has increased its federal funds interest rate over the past year to the current 1.69% as of the 17th of April 2018. The traditional view of interest rates on the value of a currency implies that low rates discourage capital inflow and encourage capital outflow. This cannot be applied here, as maintaining negative interest rates like Japan would in theory make a country very unattractive option for investment and greatly decrease demand and the value of the yen. As the yen has appreciated against the US dollar recently, it makes more sense to assume the theory that a country experiencing higher interest rates is likely to be experiencing a decrease in the value of its currency. This is because it is the real interest rate that matters, which can be found by subtracting the inflation rate from the nominal interest rate. On the assumption that real interest rates are constant across countries, a nation with a high nominal interest rate must also have high inflation. With that theory in mind, it is likely that the US dollar will depreciate against the yen. In conclusion, based on the predicted effect of Chinese tariffs, inflation, and interest rates on the dollar with respect to the yen, we expect that the American dollar will depreciate with respect to the yen, as overall depreciation of the dollar will outweigh any appreciation from relative inflation rates. From this, we predict in the near future that the exchange rate will decrease from current levels. Thank you for your time.